So what I'm going to do is I'm going to do a little bit of a review of yesterday, but I really want to focus on some of the key points to really give you some practical tips. And I'm going to go through a little bit slower today, and I'm going to go through some very recent examples to explain how you could take advantage of some of these arbitrage, as Dave would mention, arbitrage opportunities in the market. And Dave mentioned a very important word at the start of his presentation was about value. And that's what traders are looking at. We're looking at the value of the market in those very small opportunities. And arbitrage, what Dave talked about, arbitrage is just taking advantages of imbalances in the market. So price differences in the market. And that's really what arbitrage is. It's all about finding the market will return to a balance point. But when the market is out of balance, how can we take advantage of that? And that's what we basically do as traders. We take advantage of arbitrage opportunities. In minutes, in seconds, we're taking advantage of that. So let's delve a little bit deeper into what arbitrage means in terms of what we do. We do need to go through our slides very quickly for any of the newcomers that have just come in to today. I'll just take a quick sip of water. But I can ask you just to read through the slides as we go along and just acknowledge that you're aware of all the risks involved with trading the derivatives and futures markets. So we are borrowing money. It's a highly leveraged industry that we trade in. And this is why you need to be very good with your risk management. And there's always the two risks in trading, the risk of making money, risk of losing money, winning trades, losing trades, all right? It's just a normal part of business. You don't always win. Like what Dave said, even the big players like BlackRock and Vanguard and State Street, they don't always win. They're losing, but they're looking for opportunities constantly, and they tend to win at the end of the day. And that's what we want to do as well. Information is general information also, and there's no personal advice being given. And the past performance caution notice, though I'm not wearing a tie like Dave. I don't know what the market's going to do tomorrow. There's going to be different scenarios, but I'm going to be planned and ready for all those different scenarios. And that's what we mean by past performance. You're never going to be exactly spot on. Like, you can't trade the forecast. You got to trade what's happening in real time, and that can change from time to time. So past performance is not an indicator of true or indication of future performance. So let's review a little bit about what we did yesterday. And we talked yesterday about the ranges. So we talked about what's overnight inventory or ON inventory as opposed to the regular trading hours inventory. So we talked a little bit about that, and I'll review that. We also talked about what it means to be in balance or out of balance and how we can take advantage of markets when they're out of balance, or how we trade when markets are in balance. And then there's market nuances. And also I'm going to talk about drawing gaps. And gaps are really important right now. It's very topical right now because we've got a lot of gaps in the market. So I'm going to show you the correct way of drawing a gap. And a gap is not the close of yesterday's price, right? The settlement price. That's not what I'm talking about. I'm talking a gap between the high or the low of previous day compared to the current day. All right, or the day we're looking at. So the gaps between 2 days, and that will be based on the different regular trading hours price ranges. So we'll go in and talk about that. So first of all, let's talk about setting up the ranges and the overnight inventory, and I'll just review what we talked about yesterday. But there's two primary sessions. You have to understand this, it's very important. There's the overnight session, which is represented in the extended trading hours data that we get out of NinjaTrader. And there's also the regular trading hours, which are the cash market hours. So remember, with the FDAX, the cash market for the FDAX is 5 o'clock through till 6 o'clock in the morning, Queensland time. And on the S&P 500 or NASDAQ, it's 11:30 p.m. Queensland time through till 6 o'clock. All right, 6 o'clock is very important. We use 6 o'clock as the closing candle, not 7 o'clock. We use 6 o'clock, and the reason being is that's when the New York Stock Exchange closes and the NASDAQ exchange closes. All right, so we don't look at the gap's important, which is 15 minutes after 6 o'clock. That's when the gap's taken, is 15 minutes after the 6 o'clock candle in the morning. But we look at more about what the high and the low did between that time. So 11:30 p.m. to 6 a.m. in the morning, Queensland time currently, and that's going to change in November. Because of daylight saving, that changes an hour. And we'll let you know all of that for all the new traders. We'll tell you when all the trading hours times changes. But it's important to know times. It's really important to know the detail about the times. Now, if trading the regular trading hours, notice where the open is in relation to the previous day's gap. Now, this gives us, once again, gives us very good opportunities for arbitrage, all right, to take advantage of the imbalance in the market. So if price is higher than the previous gap in the overnight trading hours, look for, that just means that the inventory is long and we're looking for opportunities to trade back to the gap. That's the highest probability move in the market, will be back to the gap to balance out the inventory. All right, so we've gone from long inventory. This is short-term traders we're talking about. We're not talking long-term traders, we're talking short-term traders. Because the short-term traders are the weakest hands in the market. The weakest hands can't afford the big risk. So when the market turns against them, they need to get out of the market, like what we do. When the market turns against us and we've got on the wrong side of the equation, we need to bail out of the trade, right? We're weak hands traders. Now, when inventory is short, it just means that the majority of trade is traded under the previous day's gap. So that means most of the traders are short. If the buyers start coming into the market and want to recorrect or balance that inventory out and go back to the gap, well, those people that were short need to buy, and that's called short covering. All right, whenever you hear that term short covering, it just means buyers are stepping into the market. Now, short covering can trigger momentum buying as well. So it can be new players coming into the market and buying and getting involved with the price fluctuation. It can also obviously be the old sellers have to dump, get out of the market, or not dump their position. They basically have to buy back to square out their position. So it's very important you understand those nuances. And then if the inventory is balanced, that means just the trade during the overnight hours has been up and down, rotating around the gap generally. So it's a very stable and balanced market, which is very tough on the open. It's tough to know what the market's going to do. Sometimes we need to wait for the market to settle before it makes a decision if we've got balanced inventory, because that first trade hasn't really come through for a lot of traders. So traders that are sitting on the fence waiting for somebody to come in and drive the market around. Excuse me, guys, I'm very dry today. And I didn't drink at all last night. Surprisingly, not like a lot of others. Not mentioning any names at all. But you know what, it is a conference, and you know everyone's free to have a good time. So let's just go in. I'm just tracking out where I am. So remember the static reference points also that we spoke about yesterday. The previous day's high and low of the regular trading hours. Not so much the extended trading hours, but they're important reference points when you're trading the regular trading hours in the regular trading hours time. So let's say I was trading the open of the US market. I would look at the extended trading hours as reference points. It's very important to look at those areas. Now, there's a term called half back, which is the 50% of the range, right? It's a very key Fibonacci level, is the 50% of the prior day's range. Also the gap, which is the settlement price, obviously round numbers, brick walls, and significant fibs. So doing your preparation is very, very important. So Kev, can we bring up my chart? And I'm going to show you some examples of the overnight inventory. Okay, so first of all, what I want you to look at is, I'm going to bring my pointer up. And I want you to look at where we are currently here on this. This is my blue squares, all right? Can't see the pointer? Okay. Kev's going to come in. We've got some technical issues. Here he comes. Big round of applause for Kevin Wong. Woo! He loves pressure. It's his middle name. thrives under it. Keep talking. Sorry, guys. So anyway, oh, great, Kev. How good is he under pressure? I would have no idea what he's just done, but he's awesome. So on your Kev. Yep, here we go. So guys, so let's see if this mouse can stay still. All right, so let's have a look. And that time is, if you look down at the bottom, now this is Queensland time, guys. So this is and these are 30-minute bars as well. So I'll make them nice and big. You can see them. And the time, if you look down there, it's about so it's the 22:30 candle, so 10:30. So we're just coming into the pre-market. All right, so it's the first candle of from 10 o'clock to 10:30 is the 10:30 candle. So I'm going to give you a bit of test of your knowledge. All right, so this is the overnight, which is the Asia, European, and now we're into the coming into the US Open. So if you look at my numbers up here, this is the gap from the prior day. Right, so that was the regular trading hours from the prior day. So you can see the first candle down here of that is the 12 o'clock candle, which is the opening 30-minute period of the US market on the S&P 500. Okay, so I'm going to give you a question to see if you've been listening. Now, what is the highest probability move that this market's going to do based on where inventory is currently sitting in the market? And first of all, is the inventory short or is the inventory long? Or is it balanced? What do you think? So inventory short, yes, Cole. Yep, Sunny, short. Kerry, short, 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 short. Okay, well done. So remember, it's probabilities, right? So if inventory is going to be balanced, we're likely, and one thing you've got to note too, the market hasn't moved out of yesterday's range at all, even in the extended trading hours, hasn't moved out of yesterday's range. So as David talks about value, the market is holding within yesterday's value. All right, so value hasn't changed very much today. So what are we likely going to expect if value hasn't changed? Well, we're likely going to expect probably rotational trading, or we're going to see the market stay within maybe yesterday's balance zone or between yesterday's high and low. So let's have a look and just see what happens. So leading into the pre-market, if you were trading in Johnny's session, you might potentially look for a trade back up to the gap. There's the first candle. There's the second candle. And now the next candle, which will appear, will be what happened in the first 30-minute period. Let's see if they close the gap. Boom. So on the open of the market, if you were trading the open or leading into the open, and you had a situation where the market was fairly balanced and the value looks like it was going to be the same as yesterday, we didn't see anything changed from overnight, like the market didn't sell down overnight or it didn't gap up overnight. It was fairly balanced. We're likely, remember, probabilities, guys, you've got to think in probabilities. We're likely going to see the market return back to balance and back to the gap. And all this inventory, all this short inventory, they're going to be taken out. And that's, you can see all the step breaks on these 30-minute charts. All right, so we've got step breaks of those levels and the market goes back to that level. So that's the first thing I really want you to get. If that's the only thing you get out of this presentation, well done, because you're really starting to understand it. The key thing is to really break down your charts into those overnight hours and those regular trading hours. So let's keep going and let's see what happens in this day. So the market basically tested the high. It's broken out of yesterday's range. And then we closed, looks like we closed outside. So that was the high of this current day. So this being the, what date is this? Well, this would be the 22nd, all right? So this was, what date's this? So sorry, this is the 21st. So that's the 21st. Now let's see what happened on the 22nd. So the market closed. We had, interesting to note though, the market the 6 o'clock candle closed outside of yesterday's range. So we're seeing a change in the environment. But what happens is interesting to note, and this is a really important thing for the US close traders to make mention. And there's a really important reference nuance, and I'm going to go into a nuance here in the market, and it's called time framing higher. And what time framing higher means is that the market on the US close here, it kept what was called time framing higher. There was consolidation around the gap, but what actually happened coming into the close is that the market was quite bullish, all right? So we've seen the market go up, and we don't see the lows of any of these 30-minute candles being broken. Now, what that means is if the 30-minute candles keep going up and the lows aren't being broken, it means that the market is one time framing higher. And that means if you're trading in a long trade and you're holding a longer, slower trade, it's best to stay in that trade until the low of the 30-minute bar gets broken, because that's a sign that the market could potentially start to sell off. So what we see right now in the runoff period on the 30 minutes to the 30-minute candle to 6:30 and the 30-minute candle to 7 o'clock did a bit of a runoff. So there was a bit of a late sell-off. So there was, what would happen there was that there was some traders in the market that couldn't hold overnight positions. And like we do, like we suggest to you guys, don't hold overnight positions because a lot of traders can't afford the margins. So you get sometimes we get this late runoff at the end of the US trading session, where if the market was long, traders have to get out because they can't hold those long positions. So you start to see a little bit of weak traders getting out of the market, and you can see the weak traders starting to sell. So watch that level, watch the 30-minute period. If it's been running up for a fair amount of time and you're getting this one time framing higher, watch the bottom of that 30-minute bar, because when that 30-minute bar breaks, it could trigger a selling opportunity or even a buying opportunity. But in this situation, a selling opportunity for the market. And we can see the market finish there. All right, so that was the end of the day. So let's just quickly go through and just see what happened the next day's inventory. Right. So the gap, guys, so you're aware the gap is that dotted or that dashed line there, right? So that's the gap. So the market is short, the market longs, and you watch, see the behavior off the gap. The gap is a really important level. You can see the markets obviously started short, and then there's a bit of buying coming into the market. And where does the market go back? It goes back up to the gap, which is a nice balance point in the market. And we look in the overnight here, the market pretty much just rotated around the gap. Now, I'll just bring the chart down. So now we're coming into the open of the US market. What would you say about the inventory at this point in time, based on what I've taught you? All right, so yes, it's balanced. It's balanced. However, leading into, if you said long, you're right too, because look at what's happened coming into the open of the US market. The market has gone long, and also we're outside of the range of yesterday. So we've had a bit of a bullish spike. But remember, US traders will consider the traders that are in the market right now, they'll consider them as weak-handed traders. Remember that. So even though it was balanced at or pretty much most of the day, we had a late flurry of buying coming into the market, just trying to, obviously, people trying to front run the market. There might have been news announcements coming out, European traders, short-term traders trying to drive price up, trying to get in early and take advantage of a pop, all right? Let's see what happens though. Remember the odds that we're likely going to come back to the gap. There we go. We came back to the gap, and that was the, what candle was that? That was the 11 o'clock candle. So even before the pre-market, the market came back into a balanced state. And notice once again, the one time framing higher. I think Ryan pointed that out. See how we were one time framing higher most of the European, the late part of the European session. we had a little balance candle in here. All right, when you see those little balance candles, you pretty much just stay out of the market, come back tomorrow. Oh, not come back tomorrow. Come back in about a half an hour's time or an hour's time to come back to see if that level has broken. And you can see once that level breaks, look what happens. You get quite a strong selling move back down to the gap, right? So that level there is the gap. Now, what's going to happen around the gap on open? All right, so we can see a chance for a sell-off. And then the market comes back. So shorters tried to short off once again, try to front run the market, tried to short the market, and they quickly got slammed and the market just went back straight up through the gap. And now we're testing yesterday's high. And we may see a little bit more momentum to the high side. So we got a little bit more follow through in the momentum of the buyers, all right? And then we'll see the market just sort of get, it's all over the place, very choppy trading. So what we can see from this situation is, we'll sort of go to my next segue, is the market's opening in balance. All right, we look at the market here. Yesterday, the day before, that was the range of the day. And we can see here, the market actually opens up in balance. Remember, that is the 12 o'clock candle right there. So that's the opening 30-minute period. So we can see the market opens well within balance. So what does that mean? So let's review some of the rules if the market opens in balance. If I just go back to the slides quickly, Kev. So if the RTH opens in or out of balance, if it opens in balance, it means the RTH open is between yesterday's RTH range. Have we opened between RTH range? Yes. All right. Now, if that happens, we're likely going to get a rotational day, and we're going to basically have two-sided trading. That's the odds that we're going to have up and downs. All right, there's going to be moves up, they're going to be moves down. Remember, it's probabilistic, not always going to be the situation. Now, if the market opens out of balance, it means the RTH open is outside the previous range. And it's what's going to happen, we're likely going to see a trending day when the market opens out of range, because there's something has changed in the market. There's a completely different set of eyes. There's a whole new look on the market. Something's out of value. Wow, let's take advantage of the market being out of value. All right, so there's going to be all new traders coming in. And this is where we make most of our money, is when the market is out of balance. All right, and markets are going to discover new areas in the market. So let's go back to the chart. Kevy, can we come back to the chart? Thank you. So let's have a look at what happens this day. And I'm just going to go through it very quickly. So we've opened up. I'll bring in the whole range so you can see. So interesting to note, the market tested the high of the overnight. All right, so what happened in Europe? It tested it and failed. Couldn't get above a very important reference point and failed. And what was the likely thing we're going to see is probably two-sided trading. However, we get a nice selling opportunity, and then the market starts selling down. And where does it go to? Goes to the low of the prior regular trading hours low. So very key reference point. So when you see the market selling down, the first port of call would have been the extended, the overnight trading hours low, which was right there. You'd see the market hesitated there for a little while. Then when the market got under there, where was the next level it was going to go down to? It was going to go down to the low from the prior day. But also, if you see this magenta box I've got on the chart, that is a gap. And I'm going to get into what a gap is very soon. So the market went down and it tried to test the gap. But the first key reference point was the low from this day, which would have been on the 21st of October. All right, so let's keep going. So the market fails at that key reference point. Do we get an opportunity to trade back long? Where's the next reference point? Where would be the next reference point? Guys, if we're going to get two-sided trading, where would you look to trade it up to potentially? Let's just throw a fib in there to see if we can get back up there. And what do? We went straight back up to the 50, especially as soon as we broke the 30-minute high, the high of the last 30-minute candle. Remember, we had a balance candle in here, doji candle imbalance. As soon as we broke, we had a nice move. Now, I know this is the S&P 500, and I know I'm looking at a 30-minute chart, but if we look at how many ticks that is, from that 30-minute candle up to, just a very conservative reference point, that's 3.25 points, which is what, 13 ticks. Now, what does Greg Sinclair go for? 4 ticks, right? You just need 4 ticks. You're trading 20 contracts, that's a $1,000 trade, all right? And you haven't even got to the 50%. So, when you get to understand the market nuances and how the market relates around value, the market looks at value so much, and it's looking at where the market is in relation to yesterday's balance is such a key reference. So I really encourage you to take the time to study and prepare your charts so that you can break your charts up into what's overnight trade and what's regular trading hours trade. And the reason being is the regular trading hours takes up 85 to 90% of the volume. And those traders that are taking up 85 to 90% of the value, of the volume, they're representing most of the value in the market. What's happening in the overnight trade doesn't really affect value that much. So it's very important to break up your sessions. And and I'm not discounting the overnight trade at all. They do provide very good reference points. But it's all about the value. It's all about what the market sees as value. And that's what we're trying to determine. And if value is balanced, it's going to come back to the center point in the market. So that's pretty much what happened Friday on the S&P 500. And by the way, guys, we broke all-time highs. That was the old Globex high that we broke. And I explained to this with our TBS students during the week. And this is what I said at the start of the week when I was talking to them about this in a bit more detail. I said the old Globex high is a very weak reference point because the prior high before that was the 6th of September, and it was done on a public holiday. And it's a very, very weak reference point to have a public holiday high when there's hardly any trade. But also even weaker because the high of the whole market, the highest price was made during the overnight trading hours. So that was seen as a very weak reference. And this is why we've seen, if I scrunch up this chart, we've seen such a massive attempt by the buyers to retest the high. And look at all the purple. These are all gaps. And what that means is the market has been very bullish, and that old Globex high has been a very powerful reference point, and the market had to clean that level up because it was such a weak level. The market had to come up and fill it and take it out. And that's how markets work. They look at weak reference points. They look at weak areas in the market and they clean it up. And that's why we've seen such a massive bull. Like we saw a lot of traders were thinking here weeks ago that, oh, this is the start of the sell-off. Even I got trapped going short down through here on another account, on a longer term account. But when I got to understand that, hang on, this market's breaking out and this is such a weak reference point, I got out of my position pretty quickly and covered my short. And the market has gone up and gapped up and gapped up and gapped up, all right? And it's had a huge run. So what does that mean for us as traders with these gaps? And what I'm going to do now, I'm going to show you I'm going to show you how to draw a gap and how to work out a gap, because it's really important to do that. But the reason why I'm showing you these gaps is that they've been made so quickly. It's a sign of an erratic market, and it's a sign of a market which is out of balance, and it's a little bit crazy. So if markets can go up this fast, they can come down that quickly as well, and they can clean up these areas, because these are gaps in the market will be tested at some point. When, we don't know, but at some point they will be tested. I know the NASDAQ gap was cleaned up on Friday, but the S&P gap hasn't been cleaned up. So let's have a look and see where we are on the S&P. So that's where the market, this will be the gap. Somewhere around here will be the gap for when we're trading on Monday. The gap will be somewhere around here. So it'll be interesting to see what the market does from here. All I can say is that we've got overlapping value. So the market has been trying to go up. We've got a big overlapping value here, which is a sign like an outside candle. An outside candle is sometimes a sign of uncertainty and market potentially moving into imbalance. But we would say that the market is still balanced in this situation. All right, so we're going to wait and see what happens here, but it'll be interesting to see what happens overnight in the Asian market. If the market gaps down and goes lower, or opens up and goes higher, it'll be interesting to see. But now you'll know how to handle yourself when the market does do that. Remember, if the market opens well and truly outside of the range of yesterday, what we're going to be looking for, the market to try and test to come back into the range. If it can't get back into the range, that's a sign that there is imbalance. Something has changed. Traders are seeing something different, and that the market could move well and truly out of that balance area, and we could be seeing a change in environment, a downtrend, or even an uptrend. So watch to see where the market opens up in terms of the regular trading hours, where it opens up in terms of yesterday's value. And like I said, if it opens up, it might if it comes back into value, it might come back and test the bottom side of value like it did on this particular day. The market went out of value, failed. Remember, look to see who's failing, to see who's winning. If it gets out of value and fails, we're likely going to come back and see a retest of the bottom of the prior day. And that's what we got there. All right, so if it tries to jump out of value or out of balance, watch for continuation. If it fails, reverse it. All right, reverse the direction. So very important you have these key reference points in alignment. All right, so the next thing I want to talk about is how do you draw a gap, or how do you work out a gap? Very important nuance in the market. So how do I work out the one from the S&P 500? Okay, first thing I needed to do was so on that particular day, that was the high. Remember, very important, the high of the regular trading hours is the 6 p.m. 30-minute bar, or 6 a.m. 30-minute bar for me in Queensland, right? So it'll be, if you're in New York, it's 4 o'clock. If you're in Chicago, it's 3 o'clock in the afternoon for our American friends today. So that's where the market, that was the final candle. This is just considered overnight inventory still. All right, this is all still a part of the Asia-European complex, all that. All right. So where does the market open on the prior day? It opens. Let's have a look. Just get my. Okay. So that was the opening candle, right? So that's the opening price. So that there, I've just got to make a slight adjustment to that. I've got to bring that down to right there. So that was the low, that move, right there. Can everyone see that level there? I'll make it a bit bigger so you can see it. Right there, okay? So that's the low of the RTH. Now, the market on that particular day never comes back and closes the gap. All right, so the market tried to come back and test it and failed right there on that level there. Right, so it never came back and closed the high from the prior day. So that was a sign of like a liquidation break here. So buyers were long, all right, they got short, all right, sorry, they got trapped here, and then we had a bit of a sell-off. Remember, weak hand traders sold off, and it pulled back right to the low of the day. But then we got a strong recovery from the buyers, and we ended up fairly balanced in the day. Even though we're outside of the prior day's range, we managed to stay outside of the RTH on that particular day. So what happened is we've created the gap. Now, the extended trading hours, we don't concern ourselves. Even though the extended trading hours close the gap, it doesn't make any difference. The gap still carries over, because all that matters is what happens with the RTH. So let's have a look and see what happens. The market comes down. The market here came down, tried to close the gap. So still can't close the gap. So this market could still go higher from here. This gap is still holding up, which means if a gap can't get broken, it's a sign that the markets could still be going up. So just be very mindful that this isn't definitely not going to sell off at all. But if the market breaks this level, all right, then what we're looking for is key reference points. And if we look at the key reference points below the gap, we've got 4,500, very important reference point in the market. And we've got a series of all these other gaps that the market may try and clean up. So we've got a gap there. We've got a gap there, and then a gap way down here somewhere, I believe. I know that might have been it. So there's 3 pretty prominent gaps in the market which could be filled up. So they're going to be very important reference points to watch. If you mark these levels up and you're trading around these areas, watch for behavior. If the market can get into the gap, and watch for a hunt, the market will try and test the other end of the gap and try and clean it up. If it can't get into the gap and fail, then you might look for an opportunity to trade away from that level and reverse off those levels. So guys, there's a couple of the nuances I just want to explain. I think that's a bit of a wrap. Any quick questions about any of that information? Okay, so there's so many questions. I don't know where to start. I'll start with Andrew. Cam, do we determine in balance and out of balance using just the 30-minute candles or any other time frames? You can use any time frame. I just use the 30-minute candle because the 30-minute candles, remember I said yesterday, the market opens at, the US markets open at on the half hour. All right, so it's important that you use the half hour time frames. I find that they're easier. And like I said also that a lot of traders look at 30-minute bars. The index traders use 30-minute bars. How does this apply to DAX with such a short extended trading hours? Yes, great question. The DAX has an Asian trade. You wouldn't know it, but the DAX does have Asian trade. It opens at 10:15. The only problem with that is it's very light volume. All right, but it's important to know the high and the low. They can be key reference points. What happened during the Asian time? The only thing is it throws off your 30-minute candles because the market opens at 10:15 on the DAX. If you run a 30-minute candle with extended trading hours data, it throws out all your 30-minute candles. All right, so I don't use extended trading data for the 30-minute bars. I use it on the 5-minute candles, but on my 30-minute charts, I just use the regular trading hours. So the pre-market is the first hour. You'll get that data. All right, that's a part of the extended trading hours data or the overnight data, but I'm really focusing on what happened during the RTH. So when the gun goes at 5 o'clock. Adrian, is it possible to show us how you draw the gap from the US Open to the US close? Are you talking, I hope I showed you that in that example. So the gap was remember the high is at 6 o'clock in the morning, all right? Whatever that was the last, or that was the high of the day, is between 11:30 and 6 o'clock for me. All right, so that is not, even though it's traded in that day, it's a part of the regular trading hours still. And I looked at what happened on the prior day, or the following day, and you can see that was the range was created in that day. So we haven't come back and filled this gap yet during the regular trading hours. 2 days we've been holding above it, which is interesting. Market can't close the gap. RTH stands for regular trading hours, so it's the cash market. So if you want to go in and tweak with this, I'll quickly show you. If you go into your data series, if you look at instrument settings, if you scroll down, this is CME data. So it's the CME US Index Futures, regular trading hours, RTH. All right, that's what I'm showing you right now is the ETH, which is all of the data. That's what we typically use, is all of the data. But if I wanted to break it down into what's happened during the regular trading hours, I would use that one. Okay, but I don't use that. I just use it all, and I just use my boxes to tell me what's what. All right, so guys, we can talk more about this later. There's so much more information. I do teach a lot about this during our trading business school. I do talk a lot about the market nuances and a lot about reading the structure of the market to help you with understanding the direction and the probabilities, and to take advantage of those arbitrage opportunities that exist in the market and those imbalances in the market. And just one of the simplest rules is just to watch to see what's happening with the overnight inventory. And even though most of us trade European trading hours, it's important even to watch what's happened. What's the Asian market has done? Are they net short? Are they net long? And watch if the European traders try to write off that inventory as well. They may be big enough to try and write that inventory off at times as well. So they can move things around as well. But the regular trading hours, guys, are the ones that you really want to be focusing on, because they can really change the market around. So guys, we're going to now move to our state change. Hope you enjoyed that content. I know it was pretty heavy hitting, but I really want you to understand that there's so much more going in the markets. And if you can understand the psychology of the market around value and balance, and to try and take advantage of these opportunities for you to profit in the markets, and think about the smart money, because we want to take advantage of the weekend traders. That's what we want to do as traders. We want to trap those weekend traders that trade from emotion, and we want to trade from facts, logistics, and absolute statistics, and what's happening on the chart. The data that the chart is giving us is the reality.